Grain market update. Corn, soybeans tick up, wheat steady, livestock prices mixed. The agricultural markets presented a mixed bag of results today, with grains generally trending upwards while livestock experienced a more divided performance. Let's dive into the specifics from the Chicago Board of Trade and the Chicago Mercantile Exchange. Grain prices, a gentle climb. Most grain futures saw a slight increase. September corn futures edged up by 1/4 cent, settling at $3.81 per bushel. September wheat held steady, remaining at $5.08 per bushel. However, September oats bucked the trend, falling by a notable 8.25 cents to $3.33 per bushel. September soybeans also saw a small gain, rising by 1/4 cent to $9.71 per bushel. To put this in perspective, these fluctuations, while seemingly small, can have a significant impact on farmers' profitability and, ultimately, the price consumers pay for food. Even a fraction of a cent change, when multiplied across millions of bushels, translates to substantial sums. Livestock, a tale of two markets. Over on the Chicago Mercantile Exchange, the livestock market presented a more complex picture. Beef prices were mixed, indicating some uncertainty in that sector. October live cattle futures experienced a healthy increase, rising by 3.47 cents to $2.28 per pound. This suggests potentially stronger demand for finished cattle in the near future. However, September feeder cattle, younger cattle that will be fattened for market, declined by 2.12 cents to $3.40 per pound. This could reflect concerns about future feed costs or overall market conditions. Pork, on the other hand, showed positive momentum. October hog futures gained 1.88 cents, reaching 93 cents per pound. This increase could be driven by factors such as increased export demand or a reduction in hog supply. But here's where it gets controversial. But some analysts believe that these seemingly small price movements are actually indicative of larger shifts in global supply and demand. For example, the slight increase in soybean prices could be a precursor to a more significant rally if weather conditions in key growing regions deteriorate. Similarly, the decline in feeder cattle prices could signal a broader trend of reduced profitability for cattle producers. And this is the part most people miss. It's crucial to remember that these futures prices are not just about today's market conditions. They also reflect traders' expectations about the future. Factors like weather forecasts, government policies, and global economic trends all play a role in shaping these expectations and ultimately influencing prices. A question for you. Do you think these small price changes are just noise, or do they represent the beginning of a larger trend? What factors do you believe will have the biggest impact on grain and livestock prices in the coming months? Share your thoughts in the comments below. November soybeans, a dead cat bounce, market analysis and forecast. Is the November soybean market just a dead cat bounce? Here's a bold statement for you. Despite a modest rally in new crop November soybean futures this week, the outlook for sustained strength is bleak. But here's where it gets controversial. With zero new crop China purchases of U.S. soybeans, favorable weather until mid-August, and numerous private analyst forecasts predicting record soybean yields, rising supply and sagging demand could spell trouble ahead. Without a quick resolution to the U.S.-China trade standoff, U.S. ending soy stocks in 2025-26 could skyrocket to over 500 million bushels, possibly approaching 700 million. Factor in the record Brazilian soy crop and lower Argentine export taxes, and sustaining any rally becomes an uphill battle without a late August weather shift or new China trade commitment. If November beans advance further, expect major selling in the $10.10 to $10.20 range, just 12 to 20 cents above current values. The trend is your friend, as fund managers extending their net short positions in Chicago and Kansas City wheat would likely agree. With ample supplies in Russia and the EU following harvests, the U.S. faces stiff competition for wheat business in coming months. However, oversold Chicago wheat and strong U.S. wheat export sales exceeding USDA expectations could signal a turning point. As Chicago September wheat nears the $5 support level, will typical U.S. wheat importers step up to buy at these cheap values? And what impact will Russia's wheat quality issues have? I'd love to hear your thoughts. Do you agree with this assessment, or do you see a different outcome? Let me know in the comments. Please note, the above comments are for educational purposes only, and not specific trade recommendations. Commodities, futures, and options trading involve substantial risk and isn't suitable for everyone.